Centralized exchanges are the most threatened they've ever been in their existence. And decentralized exchanges across all fronts, both spot and perps, just continue to eat market share.
Hi everyone, welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. I'm here with Ryan Watkins, co-founder of Syncracy Capital, and Sunny Shi, investor at Syncracy Capital. But before we dive into this discussion, we are going to give a little love to our sponsors, Token 2049 and Binance.
The crypto world is buzzing. On October 1st and 2nd, 25,000 people will be at Token 2049 Singapore, the largest crypto event in the world, featuring headline speakers like Eric Trump, Vlad Tenev, Tom Lee, Balaji Srinivasan, and Arthur Hayes. Visit asia.token2049.com now to get 15% off tickets with the code UNCHAINED. Binance is the world's #1 crypto exchange, trusted by over 290 million users. With industry-leading liquidity, security, and a wide range of digital asset products, Binance is the place to buy, sell, trade, and earn crypto. Download Binance today to get started.
Welcome, Ryan and Sunny. So everyone's been buzzing about Hyperliquid versus Aster, and I feel like we're doing the show a little bit late. Like there's been a lot of discussion, but as Ryan especially knows, we're trying to get a show with different perspectives, like somebody who was kind of more on the Hyperliquid side and somebody more on the Aster side. Honestly, we had a bit of a difficult time finding someone who had a strong conviction that Aster was going to win. So we decided to have Ryan and Sunny. They're both, Hyperliquid bulls. Syncracy, I think, has a big position there. So just take what they say with the knowledge that they have their Hyperliquid bags. But to give some context, Hyperliquid obviously has been this darling of the industry for this past year. There was a lot of talk about whether or not it could take on Binance, which is kind of funny because I just realized that they're one of the sponsors of the show. But anyway, so CZ, the founder of Binance, and Jeff Yan, the founder of Hyperliquid, kind of got into these like little mini tweet debates about, the merits of having this Perp DEX with, information that was transparent to everyone. But in the last 10 days, Aster, which is backed by YZi Labs, formerly Binance Labs, it's actually jumped to the top of the list of Perp DEX volume. Some of the reasons might be like it just launched a token, but also CZ, has been promoting it to his 10 million followers. And so like when you look at DeFi Llama now, it's at the top of the volume rankings for 30 days, 7 days, 24 hours. And Hyperliquid is like generally around third for, I think most of them. Lighter is what's in second place. I don't know about all of them, but definitely for a 24-hour. So, if we also look at the tokens, the Aster price has gone from 56 cents to $1.58 as of like an hour ago when I wrote that. And across the same time span, the Hype price dropped from its all-time high of $58 down to about 45 now. So, Ryan and Sunny, why don't you go ahead and explain, why you think we're seeing this flip-flopping of the Aster and Hyperliquid volumes? I know, you guys are bullish long-term, but just explain kind of what we're currently seeing. And either one of you can go
sure.
first.
So I think in a snapshot, it can look like anything is true. And if you look like at a snapshot today, you will see Aster doing a ton of volume, Layer doing a ton of volume, and even surpassing Hyperliquid. But I think what's really important here is just to zoom out on what is like the big thing that is happening underneath the surface. And what's really happening is that centralized exchanges are the most threatened they've ever been in their existence. And decentralized exchanges across all fronts, both spot and perps, just continue to eat market share. So if you look at it just statistically, decentralized exchanges account for 30% of all spot volumes right now. Most of that was led by early on to Solana and its meme coin trading. And then now even some of the more like majors are starting to capture on. Unit's been doing a good job for Hyperliquid. And then for the perps, that's usually around like 5 to 10% as well and growing. And mind you, both of these numbers were, barely like a rounding error, like even like 2 years ago. So it's just been up and to the right, and it's been a big threat. And why do these centralized exchanges care in the first place? It's because like perps, just as one example, are like the single largest source of revenue for these exchanges. And we're not talking about this like being a single digit billion. This is like a double digit $1 billion opportunity many times over. This is like the largest source of profit pool for them. And finally, they're being threatened. And when you think about during 2021, during that cycle, with the rise of DeFi, a lot of these exchanges just didn't really care. They're like, all right, people can trade all the little DeFi tokens on their AMMs. It's not going to compete with this no term. But now they're actually starting to step up to the plate and really play ball here. So, when we look at Aster versus Hyperliquid, I think that's almost like not even like the right framing. To me, it's just decentralized exchanges versus centralized exchanges, and not even just like Hyperliquid versus Aster or Hyperliquid versus the field. And it's no surprise that like you see not only Binance backing Aster, but you even see Bybit building its own kind of like decentralized perps exchange, because they realize that, okay, if trading is going to move on chain, if perps are single largest source of revenue going to move on chain, then we need to play here too so we can capture this. And I think that's really what's happening right now.
Sunny, what about you?
Yeah, really quickly, I think Ryan put it really well. Before I joined Syncracy, I was at Masari, where I wrote 2 pieces in this series called The Club Wars, where I was highlighting the rise of these on-chain order books. So on-chain order books, I thought, was a better distinction than, let's say, DEX versus CEX for this specific scenario, because a lot of these next generation perp DEXs are launching as on-chain order books. And the opportunity is huge, as Hyperliquid has painted. Like, there is still 80% left market share to capture from the centralized exchange pie of perp volumes, derivatives volumes overall, trillions of dollars of volume a year. And I think it was a matter of time before this meta would emerge, is kind of what I thought, because you never have a leader like Hyperliquid come out, take 90% share in this on-chain vertical, and then hold that into perpetuity. It always gets more competitive at some point. Like we saw this with spot DEXs, with AMMs like Uniswap and SushiSwap. DYDX getting disrupted by Hyperliquid after holding like a monster market share for perps in 2023. And so this is just something that we've seen occur. And I think some nuances is probably warranted here, in that there is very, very much plenty of white space left to capture against centralized exchanges. But one is remarkable retail flow they've been able to aggregate. And I think that's the key distinction here, is how much of the volumes we're seeing are real organic flows coming from retail users who are willing to put on a position for a certain period of time and either lose money or make money. And I think in that regard, Hyperliquid is still undisputed. I don't think it's even a dispute what might come out of grams and what might come out of this competitive landscape between these different on-chain clubs kind of fighting for market share. I think we'll start to see the waters get a little bit more contested. But I think for now it should be I think the nuance should be addressed when it do what is organic and what is innovations are driving this on-chain club meta forward. What are real innovations? What are just paper narratives being touted by members of CT? So that's I think kind of where we'll get into the meat of this discussion today, where it'll be pretty interesting. But in general, I agree with Ryan. This is the mega trend of on-chain clubs and on-chain order books and on-chain DEXs taking share from centralized exchanges.
Yeah, before we get into kind of all that stuff, because I agree that that's like the more significant, bigger trend. Let's just talk about like some of the kind of like recent news to just put all that into context, and then we can get into what it all means. So when you talked about like organic versus inorganic, I'm assuming you're talking about the Aster airdrop that's coming up. They have this points campaign. They're saying this airdrop will happen in Q4. So, maybe just like explain like what effect you think that's having on this temporary, or like, I'm assuming you're saying that you think it's temporary, like what we're seeing in the volume. So just like talk about, why we're seeing this action, like, what you meant when you were referring to like organic and inorganic.
When you look at the early stages of Hyperliquid point seasons, it was a little bit under the radar, I think, because people did not understand the true opportunity at hand. So people were farming Hyperliquid back in 2023 and 2024. And they thought that Hyperliquid would just be maybe like another iteration of DYDX, maybe a $2 to $4 billion protocol. I think if you made it very clear from the beginning that Hyperliquid would be a $50 billion FDV opportunity, you would have seen much higher levels of inorganic volumes coming in and farming that point season. And so the cat's kind of out of the bag. This is an exciting meta. Everyone wants to be involved. Aster already from like an FDV perspective, I think is north of $10 billion. And so that is a massive token opportunity if you're planning an airdrop. And obviously the response from people who might want a slice of that action is going to be larger relatively to what we saw with Hyperliquid. And you can kind of parse through the data and see some of the differences in what early Hyperliquid usage looked like relative to Aster usage. So some of the things that people have talked about on CT are volume versus OI. And so it's incredibly easy to put on short time frame positions and close them to farm notional volumes without actually holding a position for a long period of time, paying funding, risking P&L. I think it's just more complex if you're farming a protocol to hold positions for longer. And so the volume OI ratio is something that people have referenced for Hyperliquid versus Aster versus Lighter. I think something else we look at is the percentage of long tail activity relative to majors activity in terms of what pairs are being traded. And the reason why this is the case is because if you're farming volumes, paper volumes on a platform, it's much easier to farm Bitcoin, Ethereum.
Ryan, why don't you pick up on, on whatever
I think
it was
what Sunny's getting at just puts Hyperliquid open interest is larger than Lighter and Aster. And I think that's like a really good sense check to balance out with the volume numbers you're seeing. Because the volume numbers, as Sunny mentioned, when there is a clear market opportunity that everyone is playing for and they can make these big predictions on what the airdrop will be, it just attracts a lot of farming activity. So I think what Sunny was getting at is how for a lot of the volumes for Aster and Lighter are concentrated in the majors because these are really easy positions, should just trade in and out of positions and just like farm those protocols. Whereas I think for some of the long tail stuff, it's a little bit less easy to do. And that's also one of the areas where I think Hyperliquid has done very well, and a reason why I think some of the central exchanges are so concerned about its growth anyways. And this can actually be like a leading indicator in some cases. If you look at like the last, I don't know, maybe 3 big TGEs, like token generation events over the past 3 months. So think about like Pump, you think about Plasma, and you think about Aster, right? Like as of the big 3. Hyperliquid had more open interest for those markets than Binance. That's why they're concerned. That's why they're so concerned about Hyperliquid, because they're like, all right, well, if all the hottest new markets, like Hyperliquid is winning that, and not only is it winning it in perps, but it's also winning it in terms of spot as well. Like Hyperliquid was like one of the dominant venues to trade spot Pump out the gate. Then, I mean, they can kind of see the writing on the wall too, that like we really need to play ball here, because if Hyperliquid has a structural advantage in that anyone in the world can access it, and you have all of these third-party distribution platforms like Phantom that are plugging into Hyperliquid and giving it to their 10 million plus users, then this might just end up running away with it if we don't do anything. So yeah, that's how the safe essentially is.
But Ryan, I just wanted to ask you, so can you just make clear like what you think this relationship is between CZ or Binance and Aster? Like obviously YZi Labs, or I don't know how to pronounce that, but the former Binance Labs has invested in Aster. But, if you feel like it's that Binance is worried about, this competitor Hyperliquid, then like, is it that, sort of like Aster is almost like the base to, instead of BSC or BNB or whatever it's called nowadays, so many names, that it's, kind of like creating its own on-chain perp DEX, and that will be like the new version of that for Binance or something to take on Hyperliquid or something. I'm just extrapolating, but like, yeah, talk a little bit about what you think their strategy is there.
Yeah, I think if you look at the way that Aster is constructed, it is an off-chain matching engine with multiple on-chain front ends to different chains. And so it is not a BNB exclusive perp DEX. You can onboard from any number of chains. The activity itself is not actually happening on BNB. And I think, CZ, without like assuming what his intentions are, I think he very much sees the writing on the wall that the future of trading might actually occur on decentralized venues rather than centralized venues. He's actually talked about this in the early days of Hyperliquid's rise, dominance, and even predating Hyperliquid. He's talked about his interest in replicating their business on chain and in a decentralized venue. So I do believe he genuinely thinks this is the path forward. Whether or not he's going to throw all of his resources behind Aster and spend all of his time building Aster, as he's saying right now, I think that's something that I'm unsure of today. Like, will he have multiple different iterations or products or teams working on this, and he's going to monitor the situation and kind of get an assessment of what is going to be his best probability to build a winning on-chain product? Like, I think that could still happen. As I've talked about on Twitter, the Aster product itself is relatively new. It is not as fleshed out as even some of the more serious Hyperliquid competitors like Lighter, like Fogo, like Bullet that we're seeing come down the line. And so I think for now, he's definitely genuinely interested in this sort of mega trend that we talked about. Whether or not all of his eggs are behind this Aster basket.
One thing I would just say, because CZ has been talking about this trend for a long time, and I just think that the exchange founders have been aware of this trend for many years. I mean, even dating back to like last cycle. Like, what was the original motivation for spinning up Binance Smart Chain or BNB chain that actually preceded that, which was like a Cosmos chain? What is motivation for Coinbase spinning up Base or any of the other like Asian exchanges spinning up their own blockchains? It's because they can see that their business is inevitably going to be done on chain, and it's actually better to be doing it on chain. Like, if you can swap, say like Sol, for example, and you can do it on chain, then and it's non-custodial, that is a better product. If you can get the performance and the latency down and everything, that's a better product, because you don't have to worry about sending your money to some opaque offshore exchange and then some guy just like runs off and steals it, or North Korea hacks you, right? So they kind of seen this for a long time, and they've been experimenting with different ways of playing ball here, right? Whether it be spinning up their own chains or like maybe spinning up their own AMM, right? There's all these different ways they've been trying to experiment here. So yeah, I think Sonny's right to kind of situate this within the the kind of larger and long running story of central exchanges, in a way, like disrupting themselves.
Yeah, honestly, everything you were saying there reminds me of how, for so long, even though like in the wider world, people thought of Coinbase as a crypto exchange, we in the industry thought of it more like fintech, right? Because like their main product for so long was just like they had a very smooth and easy way to just buy crypto from your bank account. So that, that's more of a fintech thing. It's just like, how do you connect bank accounts to a place where you can buy crypto? And like, of course, I understand the UX to buying crypto. Like that's, another challenge, but still. And then now, there's this moment where it's almost like late 90s internet or something, where everybody knows there is going to be a Google that comes out of this. But which one will it be? And Google, of course, spawned like Gmail and Google Calendar and, Google Meets. And literally, so much of our lives now runs on Google. And so, yeah, whoever brings more people on chain, they have a shot at that. So kind of like last little recent news event that I want to just cover, because it made a lot of headlines, and I'm curious also, as I'm sure you saw, Arthur Hayes, he talked about how he thought that Hyperliquid was gonna he called it that he said it had a potential upside of 126x of where it was trading. This was in late August when he wrote this essay about it. Less than a month later, he sold his hype position because, as he put it, he needed to put down a deposit on a new Ferrari. So his team also kind of, wrote something about like the token unlocks for Hyperliquid that are going to start coming up in November. Maelstrom, his family office, tweeted, starting November 29th, 237.8 million hype tokens will begin vesting linearly over 24 months at $50 a token. That's $11.8 billion in team unlocks, nearly $500 million notional hitting the market every month. And they said that leaves a $410 million per month supply overhang post buybacks. So I wondered, like obviously you guys are bullish on Hyperliquid as we discussed at the beginning of the show, but when you look at the token unlocks, like what are your thoughts about what the price action would be over the next few years?
Yeah, I can take this one real quick. Hopefully I don't cut out anymore. I swapped over to my mobile device. But I think, I just actually went to a Hyperliquid event yesterday at Token. I'm repping the Hyperliquid shirt. Got the Hyperliquid plushie over here. Hopefully this is going to be worth a little bit of money. But I think a lot of this does come down to the familiarity that we have with the team. And, typically this is kind of an opaque thesis where look, some people are going to have questions about this team. Some people might not know them with the level of understanding that we have following them over the past year plus, and how they've executed. But, I think it is, we are confident that Jeff and the team will figure out a way to go about these unlocks that will minimize market impact on Hype, the asset. And I think that right now there's a lot of FUD surrounding what might happen post the unlocks. And we're taking a directional bet here that the team is going to make the best decision for token holders, make the best decision for the platform, as they've continuously done over the past 2-3 years that they've been building this project. And whether that means relocking their token, whether it means selling a bit in a transparent manner and then committing to holding the rest, whatever it is, we're not sure what it's going to look like, but we think this is a decision that they're going to act methodically. They're going to act in a well thought out and rational manner, and I think that they're going to prioritize the health of the token and the health of the platform, as they've continued to do, as well as the health of the community.
And are you saying that based on conversations with them that they're thinking about different ways to kind of cushion the blow? Is that what you're saying, or are you just speculating, or where is this coming from?
If you have had any interactions with this team, you'll know that they tell you nothing. There is no information leakage from the Hyperliquid team. Trust me, when I was at Masari and I was trying to write these reports, it was very difficult to get long-winded answers about anything. And so I think no, we have no. The short answer is no. We have no unique information or insight into what the team has been telling us. This is just sort of a pattern matching decision that we're making based off of the, stellar track record of this entire.
I think one thing I'll just bring up too is there's a ton of anxiety about unlocks, and I think people I remember back in 2020 or 2021, no one cared about unlocks. It was bullish unlocks was a meme, right? All the investors. I remember Solana in 2021. This was January 1st, 2021. There's this huge unlock. And I remember everyone sharing on Twitter that it was going to nuke because 90% of the supply was coming online. And, Solana was at, I don't know, maybe $1 heading to the year. And the rest is history, right? It went up to $250 by the end of the year. So no one cared about it back then. And it's only over the past couple of years that this has become a huge overhang on projects, right? And everyone's concerned about investor unlocks and team unlocks. And what is the reason why? Well, I think it's because a lot of these coins are being unlocked at higher valuations that many of these projects can't sustain. So yeah, if you're some new L1 or L2 and you're trading at a $5 to $10 billion valuation and no one's using the platform, then fine. If it's unlocking at $10 billion valuation, I mean, it's going to go down. I mean, you'd be stupid if you were gotten to the seed round at $50 million, something like that, and you're up a crazy amount to not take any profits, right? So I think that's one key distinction here is that I do think that you can actually justify the Hyperliquid valuation fundamentally. And I think that provides good support. But another key factor here is there are no investor unlocks. And I think the investor unlocks, to me, tend to be more dangerous than the team unlocks because many funds actually have obligations to return money back to investors over a period of time, right? So, maybe you're a venture fund, this is one of your biggest wins, and you haven't sent any money back to investors. Well, here's a big win, take some off the table, send it back to investors, you can go raise your next fund, right? the team doesn't really have the same set of obligations, right? They just can sell if they want to. So then what are you making a bet on here? You're making a bet on the team. It's always a founder bet at the end of the day. And you just have to ask yourself, are these people that created this project to exit 1 year after the TGE, or these people who want to actually build one of the largest projects or largest blockchains in the world? And I think that's really the bet that we're making here with the Team Unlocks, that these people have the right they have the right set of values here.
Okay, so in a moment, we're going to talk more about, kind of like the greater significance of like what this trend means and what is going to be happening in this space. But first, we're going to take a quick word from the sponsors to make this show possible.
Binance is the world's #1 crypto exchange, trusted by over 290 million users globally. With world-class liquidity, security, and a wide portfolio of digital asset products, Binance makes crypto easy for everyone. Whether you're new to crypto or a professional, Binance offers a simple user experience. Learn with Binance Academy, browse hundreds of tokens, and track your portfolio on an easy-to-use dashboard. For experienced users, Binance Pro provides industry-leading services and bespoke trading products. With some of the lowest fees and deepest liquidity in the market, it's no wonder over 290 million users choose Binance for everything crypto. Buy, sell, trade, earn, live crypto. Download Binance today and begin your journey into the future of finance. Disclaimer: Binance is not available in certain countries, including the US. Check its terms for more information. Binance.com/en/terms. Eric Trump, Donald Trump Jr., Tom Lee, Vlad Tenev, Paolo Ardoino, Balji Srinivasan, Arthur Hayes. These are just some of the headliners at Token 2049 Singapore, the largest crypto event in the world, happening October 1st and 2nd. Over 25,000 attendees, 500 exhibitors, and 300 speakers will converge for an unmissable week. Token 2049 will take over all 5 floors of Marina Bay's Sands, transforming it into a pop-up city with 1,000 side events, nonstop networking, and immersive experiences, all leading into the Formula One Grand Prix weekend. Ticket prices are rising this week. Visit asia.token2049.com and use code UNCHAINED for 15% off tickets.
Back to my conversation with Ryan and Sunny. So I see in September that Hyperliquid actually had almost 14% of Binance's monthly perpetuals volume. And, we're literally streaming here in the last hours of September. That was August. And in September, it's looking like it'll be more like 12%. So obviously, this is a figure that has just kind of been climbing, and I understand it's like down slightly. I didn't look at kind of what the aggregate is of all these different perp DEXs. But Sunny, I know you kind of did like a big analysis of a bunch of these perp DEXs. So I was wondering if you could kind of like walk us through the analysis and through that lens of like how likely is it that these would take on these centralized exchanges?
Basically, my thesis for how this might play out in the long run is if we can get performance parity with centralized exchanges, and by that I mean roughly, comparable levels of latency, roughly comparable levels of order book liquidity depth, roughly comparable levels of UX, then the decentralized platforms will win because they'll be able to aggregate global users easier. I think a permissionless venue is going to have a larger TAM than a permissioned KYC'd one. And so I think what you're seeing now is some of these new exchanges that are being built on chain, whether it's Hyperliquid or some of the new iterations, you're getting pretty close in terms of performance. You're not there yet. I mean, obviously running a private server is going to be more performant than trying to run like a fully transparent on-chain L1 like Hyperliquid is trying to do. But there's been some clever market structure design choices that Jeff has made to kind of level the playing field. And the performance is getting close. Now, there is a big difference and a big nuance that we should kind of account for, which is that what we're seeing today on the Hyperliquid platform when we talk to market makers is there is a plethora and an abundance of profitable retail flow. So these are people who are genuinely trading because they either love trading, because they think they're going to make money, but they don't have an edge. They don't have, they don't have, they're not toxic takers. They're kind of just vanilla traders who you might liken to like the average retail user on Robinhood. And these people are not going to be putting in, billions and billions of dollars of annual trading volumes alone. But they are going to be putting in very, very valuable, desirable flow to a market maker. And it's also going to generate higher levels of profit for the platform down the line. If you look at something like Binance, there is a large percentage. We don't know what the true percentage is, but on certain days, over 50% of volumes could be driven by HFT to HFT volumes. So these are high frequency trading firms, whether they're market makers or toxic takers or people like jump trading who are basically running high frequency trading strategies on Binance. And this probably will not exist on an on-chain venue for some time. And so when you account for that difference, I think there will come a point where you kind of see this growth share chart trend start to slow down a bit because there's just a lack of that like serious contributor of just daily volumes from these institutional players that we're not going to see on chain for quite some time. But with that in mind, I think the growth trends that we're seeing today are usually from net new perp traders, net new retail takers, people who are genuinely trading, people who are offering profitable non-directional flow. And I think that that's going to be probably more valuable down the line because the institutional players are going to come when they come. And when they come, it'll probably be fast. It'll be kind of whether it's a compliance hurdle they need to get through, whether it's just getting more comfortable with the idea of operating on Hyperliquid or any of these other venues. I think that switch will flip fast. And when it does, you'll see a migration of those volumes. But for now, it is going to be difficult to get to 60, 70, 80% of Binance's volumes without that institutional presence.
And a couple of questions. So wait, for institutions, don't they need to, like for compliance reasons, like how can they use a no KYC DEX? Like, I don't know how that works.
Well, that's the problem. They can't, or most of them cannot. So the market makers can. A lot of market makers have been underwriting a business on Hyperliquid. I think basically every large crypto market maker, except for a few, are on Hyperliquid at this point. And that's just a decision of going to your team and saying, we're missing out. Our competitor X is making a killing market making Hyperliquid. We need to be on there, and then they'll get it done. But there are certainly some other players that are slower to move.
Like one other thing I'll say too, volumes is there's a huge opportunity, and we talk about this all the time with HIP3, where you will introduce new markets to Hyperliquid that don't exist on the centralized exchanges. So when people can trade US equities or pre-IPO companies or even build prediction markets on Hyperliquid, those are markets that, like I said, they just don't exist on Binance. So then if any of those start to catch any kind of traction, then you can see those volume numbers as a percentage continue to rise and even surpass some of these centralized exchanges just because of like this expansionary potential that Hyperliquid has.
Yeah, and just for listeners who aren't familiar, it's builder deployed perpetual. So in a way, it's almost like you could think of it as like, kind of creating like a liquidity pool that for like unusual assets or something on Uniswap, but it's your own unique perpetuals offering. So now walk through. Now I'm so curious because like there's just so many competitors. If I have like DeFi Llama up over here, and I could just see like so many different, perp DEXs are competing in this space. So, I think you guys have kind of like analyzed all of them, and I'd just be curious to hear how, you're evaluating them and like which ones you think are kind of like stronger competitors. Obviously it looks like, your conviction is behind Hyperliquid, but I'm sure you probably have other ones where you're like, those might put up a good fight. So yeah, I'd be curious to hear your analysis.
Yeah, I think this is one that I've been mulling over because something that you've seen with Solana, for example, is Solana at this point is not the most performant chain out there when it comes to raw power. Like whether it's speed, I think there are chains coming out that are faster. whether it's bandwidth, there are chains coming out with higher throughput. But Solana today still has continued to aggregate most of the liquidity, most of the users, most of the activity. And it's because it's performant enough, and it will continue to become more performant, but it's sufficiently performant to the extent that any incremental like X% increase in latency or decrease in latency or increase in bandwidth is not going to matter as much as being able to aggregate that set of user. And I think we're at a point today where that's happening for Hyperliquid, where if you want to see a competitor come out and really drive a change in how the market share is split up today, you're going to either need something just far more performant than Hyperliquid, which is something that we haven't seen today. Like certainly it's not an Aster or some of these older protocols, but some of the newer ones even are not offering marginal tech improvements that we think is noteworthy enough. But really, I think what's interesting is trying to compose with a wider set of user. And so one of the criticisms that Hyperliquid has had is it's a little bit too isolated, and there's nothing they can do about that. They're their own separate L1. They have the Hyper EVM to compose with, but as a whole, the Hyperliquid order book is separated from the rest of the crypto economy. And so what we're seeing today are some interesting options being built on Solana, like whether that's bulk or whether that's Bullet with a network extension, or whether that's Fogo Chain, which is a different L1, but it has an SVM client. We think that's probably the interesting next thing to explore, which is what happens when you give Solana users an option of something that is as potent or as performant as Hyperliquid to trade perps. What happens when you introduced pump fund traders or meme coin traders to perpetuals and 25x, 50x leverage? I think that will be a fun experiment. But that's probably what I'm excited about most is what is going to happen on Solana, because right now I think the team has taken a direct initiative to get something like a Hyperliquid at least in close proximity to or directly on the Solana blockchain or the Solana network. And that will probably be the most interesting thing to see for me, because that isn't about marginal tech. It's about, moving your product closer to this large set of user.
So basically let me make sure that I understand, because the way that I'm interpreting what you're saying is that in a way, Hyperliquid kind of became the next competitor for Solana. And so now the question is, will Solana have its own perp DEX that could just compete directly with Hyperliquid and not have people leaving Solana to Hyperliquid? Is that what you're, okay.
Or at least more contained within the broader Solana network.
Yeah,
Okay. Brian?
Yeah, so obviously I agree with Sunny, although we don't always agree. That's what makes it for a good investment team. So I think blockchains are network effects businesses. And I think one of the reasons why I think we called out Solana as being the next place where we'd be of most interest in identifying like a winning perps exchange is Solana has very powerful network effects. And what do I mean by this? Like when I talk about network effects for Hyperliquid or Solana? Well, let's just look at Hyperliquid as an example. Hyperliquid is supported by a number of the leading custodians. There's a number of leading stablecoins that are now issued on top of it. Leading front ends and wallets that support it, right? Exchanges that you can trade Hype on, and projects that are building on Hyperliquid. And over time, these all these integrations and all these assets that are issued on it, all of these people that are using it, it becomes like a superstructure. And if you're starting from scratch, it is really hard to replicate that over time. Like the actual code is all, for many of these blockchains, is open sourced, and it's extremely easy to replicate. What's not easy to replicate is like the ecosystem that forms around it. That is what actually makes this stuff really sticky long term. So then when you look at Hyperliquid compared to the field, you can see why like there's not as much concern and why it will take a long time for any of those to become competitive. We look at it versus Solana, that's where it actually can be like really interesting, because Solana has a ton of assets that are issued on top of it, more than Hyperliquid. There's more stablecoins in Solana. There's more just normal spot tokens on Solana. More wallets that support it, more exchanges that support it, more on-ramps, like all these different things on Solana. So if you can tap into that ecosystem, then that's actually like a really exciting opportunity. That's also one of the big theses behind many of the early Solana DEXs or perps exchanges, whether it be like Drift or any other ones. Is that like imagine if you could take your collateral that's on Camino and use it as collateral for like a trade. Like that would be like really interesting use case of composability, right?
Okay, yeah, that is interesting. But of those ones that are on Solana, which do you feel are some of the more competitive ones?
It's far too early. I think a lot of the newer perp DEXs are not even in mainnet. Some are barely in testnet. But I think what we're seeing with these conversations that we're having with these teams that are building perp DEXs on or around or close to Solana is they are trying to come out with a better product than Hyperliquid on day one. And I think when you look at some of these other competitors, whether it's Aster or any of these other, I guess, staler like perp DEXs, is they do not have the luxury to kind of wait around and try to get better to match the performance of a Hyperliquid over time or the user experience of a Hyperliquid over time, because Hyperliquid exists today and it's going to continue to aggregate liquidity. It's going to continue to aggregate users. And what we're excited about is this next generation of order book based / like perp DEX exchanges on Solana that are offering what we think are real like UX improvements. And I think that will be one to watch. Those will be the ones to watch out for, but it's far too early today to tell you like what I'm excited about. Like I think most of these players are still, I mean, just to name a few, like Bulk, Pacifica, Bullet, like they're basically still in testnet phase, if not even earlier.
Okay. And why is Ethereum or any of the L2s like not part of this conversation, since so much of DeFi is on Ethereum and it has even more stable coins than Solana?
Well, I think the amount of people that use the confluence between the Ethereum layer 1 and users who are likely going to be power perp DEX users, probably low. But I think for some of these layer 2s, like there's Avantis, which has gotten a bit of attention on base. Mega ETH is going to launch with an incredibly fast chain, and there's going to be a couple of perp DEXs on there. So some of the ones include the Mega ETH ones are like GTE, Valhalla, among some others that I'm forgetting. But anyway, like I think there's just going to be a lot of these things. It's going to be very hard to track all of them. And so yeah, if you're a perp DEX points farmer, it's probably going to be a great few months / great year for you.
Okay. But you didn't really answer my question about Ethereum. Like you basically said there are competitors there, but your thesis, I guess, of Syncracy is more like if there's going to be a competitor to Hyperliquid, it'll pop up on Solana. So like why is the Ethereum bit not part of your thesis?
Because we think that the power user for a perp DEX product, there's probably a higher percentage of Solana users today who are willing to try a product like that, or who like their trading activity today on the blockchain aligns more closely with that of a Hyperliquid power user than people on Ethereum who are depositing into Aave, et cetera. I think it's just kind of like a different customer cohort / demographic.
Yeah, I think we're open-minded
to the perpetuals use case.
I mean, first, I guess you can't build a perps DEX on Ethereum mainnet. Like you just can't run an order book on it. So it'd have to be an L2, like a Lighter or Mega ETH. And we are like monitoring all of those, and I think remain open-minded to it. But yeah, I think in both those cases, these exchanges are much earlier in their life cycle than a Hyperliquid is, and I guess in our eyes, like don't meaningfully differentiate themselves from the field.
Okay. So I'm sure you've heard this before. Everyone always talks about how Hyperliquid's main advantage is just that there's no KYC. And I wondered, obviously things have changed a lot in the US under President Trump for crypto, but, issues around KYC caused problems for BitMEX in the past, which I know it's a centralized exchange. So obviously, like, potentially the rules are a little bit different, but I just don't know if you ever think like potentially that quote unquote advantage that they have now would ever go away in any respect, or like, I'm not sure what the future is for them. Like, do you feel like there'll always be no KYC, or
Yeah, I mean,
what
listen,
are
that's
your
an
thoughts on
open
that?
question. Decentralized exchange, including ones that are even on Solana, right? Like, should people be able to trade any asset in the world without having to KYC? And that's just a question that I don't think we'll have the answer to anytime soon. That being said, I do not think that, and maybe one thing I'll add too is, I think we're in a really accommodative regulatory regime in America, which is, by the way, one of the reasons why so many of these central exchanges even feel confident launching these like Frankenstein versions of what Hyperliquid is, right? Because they're like, all right, we can just launch like a no KYC exchange too, and we don't even have to give like the pretense that this is actually decentralized or like there's like this is on chain at all. Like it's just not what those are. Um, that being said, I think it's more than just no KYC that makes Hyperliquid special, right? So I think it has, one of the things I really started to appreciate about Hyperliquid recently, and this is not necessarily versus central exchanges, but maybe just even versus like other blockchains, is that it has a very like opinionated approach to building an ecosystem, uh, but it's not the core team that is doing everything. So what does that mean? So when it comes to building spot markets, the core team did not decide to go and build out the necessary infrastructure to do it themselves. They outsourced it to the unit team. And the unit team now handles majority of spot markets. And then they're thinking, okay, how do we actually launch new markets on Hyperliquid? Well, let's actually put that responsibility in the hands of the community with HIP3. So now anyone can spin up a new perps market, and then you have like independent teams doing that. In a way, like HIP3, it is in a way like restaking, which was like introduced on Ethereum, except it's just like opinionated. Of like, this is not some like open canvas of you just restaking for everything. We have no idea what to build. It's like, let's just do restaking for this one use case right now and channel all the builder energy towards this, right? And then also like builder codes, I think was like a really big one where Hyperliquid doesn't need to go build out its own mobile application, and it doesn't need to get that mobile application distributed in every single country. You can leave that to all these third parties. You can have Phantom do it. You can have, one in Japan and one in Korea, and like all these places in the world that are all working like a swarm to onboard new users to Hyperliquid. And maybe the last thing too is that, even before HIP3 goes live, uh, Hyperliquid is listing new assets faster than all these exchanges. Like one of the reasons why so much of the open interest for all these new assets, whether they be Plasma, Aster, Pump, is on Hyperliquid, is because it was the first ones to have it. Like no one else has it, and you want to go long or short Pump before it comes out, you just go to Hyperliquid, and you kind of built up that habit amongst the users that okay, anytime there's a new hot market, I'm just going to go to Hyperliquid. That's going to be it. So yeah, I think like no KYC is definitely a key advantage it has over the central exchanges, like undeniably. But I wouldn't say that's like the only thing and the only reason why it's actually winning.
To double click on that point really quickly, Hyperunit today has like a revenue share with Hyperliquid Labs. I don't think there's any scenario where Binance would give up a portion of their real estate to a third party and share 50% plus revenue with them. And what is the result of that? Well, I think already Hyperunit has announced that the 000 token is going to be live on the Hyperliquid platform tomorrow, Thursday. Thursday, 1 p.m. UTC. I'm in Singapore. I have no idea what day is what. But I mean, on day one, the 000 TGE is going to be tradable on Hyperliquid Spot, and that's the kind of pace and execution quality that you get when you start opening up your
Yeah,
platform
I think that's like a really
to
good point
others.
too. Is
Wow.
one thing I always wondered is at what point would we start to get some like extremely high quality founders coming into the space? Because I do think that there were high quality founders in the previous generations, but they're more sparse. And what usually attracts these people? It's opportunity to make money. It's maybe a change in the regulatory environment. It's like maybe the technology improving to the point where you can build a product that people want to use. Yeah, now some of these people are here. And I think that's one thing that, I mean, even as a Hyperliquid bull, I've been surprised about. When we bought this thing first day, and I was not expecting them to ship all these products as fast as they did, because I'm just so used to like these super long product cycles in crypto where the devs just take like 2 years to ship something, and they say they're going to ship in 2 years. It actually comes out in 3 years, and it's just like super slow, and it's just clearly not like it's not product minded people. And that's just not what's happening here. This kind of feels almost like what you'd expect in like AI. Like this is where this is like a cutting edge field, and there's like a race to actually win the vertical. That's what it seems like these guys are competing for. They realize that Binance is this huge opportunity. We see a line of sight to being able to disrupt them, and let's go after it. And we have to move fast as hell, because if we don't, someone else is going to come and take it from us.
Yeah, I just was having another conversation with another crypto founder, and they were making jokes about how, like, in crypto, there was a time when you could be sort of this like mad scientist, and you show up and you like, kind of make people go, gee whiz, with your fancy math and whatever. And nowadays, no. Like product is really important. Like, I'm sure everybody saw the Robinhood chain announcement, like, and just knowing like how Robinhood is with product, like that's the kind of mindset that people are, sort of leaning toward now in crypto. So, okay, I don't know if you guys heard this, but on the chopping block the other day, they were talking about this Aster Hyperliquid thing. And Haseeb had this really interesting point, and I was so curious what your thoughts are on this. But he basically said, and I know these are like huge generalizations. He also admitted these are huge generalizations, but he was like, well, the West kind of innovates and then Asia like executes. So he had this like kind of theory about how, yeah, like Hyperliquid, and he didn't say this explicitly, but from the context, I thought he was saying like Hyperliquid, being from the West, has innovated, but then potentially Aster or like any other, he kind of called out like just like a number of like in previous times in history, there have been a number of exchanges that did quite well. So I don't know, what do you think of that? Like, do you think there could be competitors that come from Asia or from the East and sort of like adopt what Hyperliquid has done, but maybe do it better? I don't know.
Yeah, absolutely. Well, one, I would say that Hyperliquid is kind of, there's a global builder base, and the team. I mean, Jeff is, I'm not sure what his citizenship situation is these days, but like I'm not sure it's fair to blindly characterize this as an East versus West situation. And even if it were, I think, look, you can mention that sort of broad strokes, and they are generalizations. I think the truth is, there is no competitor that we've seen that even seems like it's on track to be able to replicate what Hyperliquid has done, creating like this custom fit L1 to house all of these different financial applications. And it's certainly so far not Aster. I mean, it's interesting that these comments, and no shot to Haseeb, but a lot of these talking points seem to come from people who are not actually using the Perp DEXs. And I think if we want to talk about the Aster token and the Hype token in sort of this relative style and kind of debate which one is more exciting, that's a conversation. I think that's an interesting conversation. But if we want to talk about the products themselves, I don't think it's even close, to be fair. I don't think it's even close. And I think the people who actually use these products will tell you that.
I think another thing I will, just to pull on that thread a little bit, I think what it is that the offshore exchanges, most of which happen to be based in Asia, just have historically moved much faster and are more like loose, right, than some of the US exchanges. And I get it, because if you're Coinbase, what is your advantage is that you're building this regulated exchange that, at this point can custody Bitcoin and ETH for all these ETFs. Like that's just something that the offshore exchanges would never do. And that's why Coinbase will always be more conservative. So even if they do see like an opportunity to copy something or replicate it, they'll be like a last mover. Example of this is all these exchanges launched their own blockchains at some point. But when did the ones in Asia do it? Like Binance Smart Chain, that was 2020. That was late 2020. OKX, Huobi, like all these people launched their chains in that kind of 2020, 21 period. But when Coinbase launched Base, that was in 2023, right? And when are they going to launch their Base token? Because that was also something that was rumored recently. I mean, like Binance just had their token since 2017 during the ICO boom. Same thing with other ones. I mean, you're talking about like at this point, 8 years later, Coinbase is finally contemplating launching a coin. So I think that's maybe like probably what he's getting at. I think it's like less to do with East and West. It's more just like offshore and onshore.
Huh. Okay. Oh, yeah. But I don't know. It seemed like from the way he was describing it, it's like stuff happens in the US first, but then like Asia kind of copies but executes better. But anyway, okay. Okay. Last question. So, as I said at the beginning of the show, I know you guys have heavy hype bags. And I was wondering, like, as investors in hype, what do you feel is Hyperliquid's main weakness, or like, what's the main thing that you worry about? That like, if this bet ever goes wrong, like you'll look back and be like, oh, that was the thing. That was, the reason why this didn't pan out the way we thought.
Yeah, I think there are some obvious ones that everyone has considered, and they're mostly in that black swan camp of what happens if the exchange gets hacked. Like, what happens if these co-located validators go down? What happens if Jeff is malicious? And I think these are all real concerns. And I think that they're hard to kind of forecast the probability of. But you kind of have to take this investment with that in mind, which is that, okay, there are a bunch of different ways that this can dramatically upend and go wrong. But currently, given the environment that we're in, this has the potential to be one of the highest ceiling protocols in crypto. And so I think it's almost something that you just have to take into account with a bunch of these different crypto investments, which is that, man, the downside, the potential downside is just so huge. But like, there are very few protocols like Hyperliquid that have this incredible ceiling of being able to become a potential everything exchange. So yeah, I'll toss it over to you, Ryan. I don't know if you've thought of anything else.
On like the obvious, like Sunny said, just like regulatory black swan or anything like that. There's really two areas that I think are long-term concerns to me. One is, do exchanges have moats, right? So in the traditional world of finance, what gives an exchange a moat? In many cases, like, yeah, it's like, liquidity network effects and things like that, but it's actually just regulation. It's like, all right, you're like the only person that can actually do like to do regulated trading, I don't know, in Shanghai. And that's the reason why like you're the number one exchange. Like there is no competition. No one else has the license to do it. What is the difference here? There are no licenses. Everyone can run an exchange. So that just means it's like much more competitive. And at a certain point, a certain level of just like liquidity, the experience of trading exchanges can actually become similar. So what makes the difference for our industry or just like decentralized exchanges from first principles perspective? For me, it's, the same way that we evaluate the differences between smart contract platforms. If you were to have like a exchange where the validator set is sufficiently distributed, it's been running for a long time without any history of hacks, it has all of these integrations with custodians and wallets and assets that have been issued on the platform. Over time, it starts to build a network effect that is really hard to break into over time. And that's how potentially you can build a network effect long term without regulation. But that's an open question, and that's one I do question. It's not about Hyperliquid. It's just about like this entire exchange opportunity within a crypto economy. Like, is it just something where there's always going to be fluctuating market share long term? Because that is kind of has been the history of like decentralized exchanges. Like the market share changes all the time. The second one is around, I guess, like the co-located validator set. So, I think there has been great progress we've made as an industry from having all of these blockchains experiment with like the limits of, all right, basically like questioning the assumptions that the prior generation had. So for Ethereum, they're like, all right, what if we actually did have like smart contracts and we actually had more expressivity? And the Bitcoin is like, oh no, we can't do that because that increases the attack surface. And then the Ethereum's like, oh no, like let's actually do that. And then we actually get DeFi. And that's a great innovation. And then Solana comes along. They're like, what if we actually just didn't care if like some random user ran a server like on their computer and they actually ran in data centers? And Ethereum was like, oh, no, you can't do that because self-sovereignty and all this stuff. They're like, no, it doesn't matter. We're going to get more performance. And then you get Solana, and great. Like, that's where all the spot trading on chain happens now, as opposed to Ethereum. And then Hyperliquid, similarly, comes along. They're like, you know what if we actually don't even globally distribute the validator set? What if we just all co-locate them in one place? And then we'd have super low latency and potentially be competitive with centralized exchanges. And then we can build, like, for the first time, an on-chain order book. And that's what they did. And I think that's been a great innovation. What I do wonder long term is if the fact that the validator set is co-located ultimately will limit the TAM. And in the sense of, what makes Bitcoin special is that, it doesn't matter if I'm, the United States or China, I can reliably hold Bitcoin and not have to worry that it's going to be seized from me or that someone is going to censor my transaction. It is like truly like a global and neutral platform. And that's one of the reasons why it's a $2 trillion asset today. I would think that the exchange of the future would need to be a neutral platform as well. And that's what would give people the confidence, whether they're, adversaries like US or China, that if I do an exchange here, I will get my money or I'll get the other asset on the other end of the trade. And I just wonder if the validator set is co-located, if it makes it harder to trust, because maybe that co-located validator set in a specific city, I don't know, there's like a tsunami, the servers go down, or maybe like the government just shuts it down and they have to like switch where the validator set is running. Like that would just be a concern I have long term, and that's one is hard to question. But I also think that there might be some solutions long term about how to maintain the benefits of co-location, but even have some level of geographic distribution. I think like the Fogo team is kind of like a example of this potentially.
Oh, okay. Yeah, I mean, like what you're talking about there, it just goes like, all the way back to Bitcoin. And I know like everybody talks about decentralization and like sometimes people talk about it in this very idealized way, but like another way of like using that word is to say like resilience, So that's what you're talking about. Yeah, because like, back in that, like sometimes I feel like newer Bitcoiners don't understand things like jurisdictional decentralization. And anyway, like, I don't know, just like even stupid things like when, I forgot, was it Trump who was like, all of the Bitcoins are going to be mined in the US? And I was like, that is not a good idea. But anyway, okay, well, yeah, that makes a lot of sense. All right, well, you guys, this was super fun breaking this down. I'm glad we finally made it work. And Sunny, thank you for doing this from Singapore, where, yeah, I know like you're probably jet lagged or something. But anyway, we will catch you all later.
Thanks for tuning in to the weekly news recap. Let's begin. Trump administration pulls Quinten's nomination for CFTC chair. The Trump administration has withdrawn its nomination of Brian Quintenz to lead the Commodity Futures Trading Commission, leaving the agency to continue operating under acting chair Caroline Pham. Quintenz, a former commissioner and head of crypto policy at Andreessen Horowitz, confirmed to Cointelegraph the decision and said he plans to return to the private sector. His withdrawal follows opposition from Gemini co-founders Tyler and Cameron Winklevoss, who publicly lobbied against the nomination. Quintenz released text messages suggesting the brothers sought commitments on how the CFTC would handle Gemini's regulatory disputes, requests he said he declined. Quote, I believe these texts make it clear what they were after from me and what I refuse to promise, he said. The CFTC remains without a permanent chair as Congress debates new crypto legislation. SWIFT partners with ConsenSys on blockchain settlement system. Global payments network SWIFT has announced a partnership with ConsenSys and more than 30 major financial institutions, including JP Morgan, HSBC, Bank of America, and Deutsche Bank, to build a blockchain-based settlement platform. The initiative aims to support, quote, real-time 24/7 cross-border payments, end quote, and facilitate transactions involving stablecoins and other tokenized assets. ConsenSys, led by Ethereum co-founder Joseph Lubin, will develop the first prototype. Quote, in conversation with these institutions, you clearly feel that the moment is now to bring the collaboration together, said Thierry Chilosi, Swift's chief business officer. Swift CEO Javier Perez Tasso added that the project is part of its mission to, quote, create the infrastructure stack of the future, end quote. Also, there's been a ton of positive news this week in the intersection of TradFi and crypto. Here's a recap. Visa began testing stablecoins for business payments across borders, letting firms use USDC and EURC to pre-fund transfers via Visa Direct in a bid to speed up settlements and lower costs. Deutsche Börse teamed up with Circle to integrate euro and dollar-backed stablecoins into its trading, settlement, and custody platforms under new EU crypto rules, marking the first tie-up between a major European exchange and a global stablecoin issuer. Chainlink and UBS ran a pilot that let banks use the SWIFT messaging system to subscribe to and redeem tokenized investment funds, a move aimed at bringing blockchain infrastructure to the $100 trillion fund industry without replacing existing tools. Lastly, Societe Generale's crypto arm, SG Forge, deployed its euro and dollar stablecoins on Ethereum-based DeFi platforms, Morpho and Uniswap, enabling clients to borrow, lend, and trade them around the clock using crypto and tokenized fund collateral. SEC advances plan to put U.S. stocks on blockchain. The Securities and Exchange Commission is moving forward with a proposal to let American investors trade tokenized stocks on blockchain platforms. According to the information, the plan would provide exemptions from certain trading rules, potentially allowing companies like Coinbase and Robinhood to let customers buy shares of firms such as Apple or Netflix directly through their crypto wallets. Tokenized stocks mirror traditional equities in offering ownership and dividends, but are issued as blockchain tokens that represent a claim on the underlying shares. Supporters argue the approach would speed up settlement times, which currently take at least a day. Industry giants such as Citadel Securities have warned of risks to market stability and compliance, and legal challenges from Wall Street firms could delay the rollout. SEC Chair Paul Atkins has described tokenization as a, quote, innovation, end quote, the agency should foster. Stripe opens door for companies to issue their own stablecoins. Stripe has unveiled Open Issuance, a new platform designed to let businesses create and manage their own stablecoins, quote, with just a few lines of code, end quote. The service, powered by Bridge, the crypto infrastructure firm Stripe acquired for $1.1 billion last year, allows companies to mint and burn tokens, customize reserve ratios between cash and treasuries, and select partners like BlackRock and Fidelity to manage those reserves. To comply with U.S. rules, Stripe will apply for a federal banking charter and a New York trust license, according to the information. Zach Abrams, co-founder and CEO of Bridge, joined Unchained to explain the vision. Quote, if money movement is core to your business, you should build with stablecoins, but don't build on top of someone else's coin, he added. We think this is going to become a core part of stablecoin money movement, that people are just going to want the money to be their own. ZeroStack's $401 million raise masks just $13.7 million in cash. ZeroStack, the newly rebranded Flora Growth Corp, announced a $401 million raise to back the AI-focused zero-gravity blockchain. But reporting by Unchained shows that only $13.7 million came in as fresh cash, with the rest made up of recycled tokens, warrants, and in-kind contributions. SEC filings detail that Zero-Gravity Labs supplied $150 million in zero-G tokens and $215 million in warrants valued at $3 per token, while DeFi Development Corporation added $22.9 million in Solana. The actual cash portion came from investors, including DAO5 and Abstract Ventures. Analysts warned the structure created an early liquidity opportunity for insiders, bypassing typical vesting schedules. One industry investor described the deal as, quote, the ultimate grift. Robinhood eyes global expansion of prediction markets. Robinhood is exploring ways to take its fast-growing prediction markets business outside the United States, beginning with talks with regulators such as the UK's Financial Conduct Authority. J.B. McKenzie, Vice President of Futures and International at Robinhood, explained the challenge. Quote, it's a swap here in the United States. So the question would be, where is swap oversight, let's say in the UK? That's a question that we've been asking the FCA. The company, which already operates equities and crypto trading in the UK and EU, says demand for prediction markets is especially strong in Europe. CEO Vlad Tenev noted in an X post that Robinhood has already facilitated more than 4 billion event contracts this year, calling the product a major growth driver. 00 launches fiber network to speed up blockchain transactions. Blockchain infrastructure startup 00 has launched its mainnet beta, introducing a private fiber network built to move blockchain data faster and more reliably than the public internet. At launch, 386 Solana validators, representing over 20% of the network's stake, have agreed to route traffic through 00's backbone, which spans more than 70 fiber connections across 30 cities and 5 continents. Quote, "We are building a parallel internet for high-performance distributed systems like blockchains," said co-founder Austin Federa on Unchained. He explained that public internet routing creates delays and inconsistent speeds, limiting blockchain's true capacity. The network is operated by independent contributors who are compensated in 00's native 2Z token. Jump, an early investor and contributor, received 28% of tokens, sparking debate about its influence. Kronhay's Flying Tulip debuts with $200 million raise and investor protections. Andre Kronhay's new venture, Flying Tulip, has raised $200 million at a $1 billion token valuation, but the spotlight is on its novel fundraising model. The project introduces a, quote, on-chain redemption right, end quote, giving investors the ability to burn FT tokens and redeem their original principal at any time. Kronhay described the design as a way to provide a financial, quote, floor, end quote, that eases pressure on teams to make short-term decisions. Unlike many crypto launches, the Flying Tulip team has no initial token allocation, with compensation instead tied to protocol revenue and token buybacks. Investor Dana Leitzer of Nascent said the structure, quote, forces teams to deliver, aligns incentives, and gives investors real protection, end quote, a shift some see as a new template for DeFi capital raising. In related news, Kraken secured $500 million from investors, including its co-CEO Arjun Sethi, valuing the crypto exchange at $15 billion and setting it up for a long-anticipated public listing next year after a year of major acquisitions. Jump Crypto pushes Solana toward bigger blocks after Alpenglow upgrade. Jump Crypto's Firedancer team has put forward a proposal, SIMD0370, to remove Solana's block compute unit limit following the network's upcoming Alpenglow upgrade. The change would eliminate the current 60 million compute unit cap, allowing block size to scale dynamically with validator performance. Supporters argue this flexibility could boost throughput during periods of high demand, such as token launches or spikes in decentralized finance activity. Validators unable to process larger blocks could skip them, incentivizing higher performance operators to expand hardware and software capacity. Still, concerns over centralization have emerged. Solana co-founder Anatoly Yakovenko questioned whether validators would, quote, increase hardware to support some crazy leader's big block, end quote, warning instead they might, quote, fail it and steal all the MEV, end quote. The proposal remains under community discussion. Unchained is produced by Laura Shin, with help from Matt Pilchard, Juan Aranovich, Margaret Curia, and Pam Majumdar. The weekly recap was written by Juan Aranovich and edited by Stephen Ehrlich. Thanks for listening.